Hello everyone. On this Monday, March 9th, 2020, we witnessed history being made. Just a few minutes after stock market opened, the S&P 500 fell 7% from its previous closing price on last Friday. This huge sell-off triggered the rule of circuit breaker, which then halted all trading transactions across the entire market for 15 minutes. This is definitely a very dramatic moment in the market, and many investors, especially young investors, probably never heard of this rule or are not familiar with the details. As a Wall Street Journal article reported, this is the first time we see this trading curve since 1997, which is 23 years ago. So I call this video Circuit Breaker, Live Long and you will see it. In this part of the video, I will go over the circuit breaker rule for the market and its history. Well, I hope we won't experience this again for a very long period of time. But at the very last leg of this long expansion, and when the market is like a roller coaster ride on a daily basis, having this information in mind could be handy. Hope you will enjoy it. First of all, let's go over the circuit breaker rule. Circuit breaker is part of the market volatility regulation by SEC, the Securities and Exchange Commission, as the regulator of the US stock market. In its original meaning, in the world of electronics, circuit breaker cuts the flow of electricity when there's an overwhelming surge of power. As an analogy in the stock market, they do pretty much the same thing. In the stock market, the circuit breaker system is designed to give the investor a little bit time off to reassess the situation and to curb panic selling on the US stock exchange. They temporarily will hold all the trading's entire market if price rapidly move outside of the predetermined bounds. So what's the intention? The intention of a circuit breaker is to halt trading in the security, to prevent fear and panic selling from collapsing the entire market without any fundamental movement of the price. The system of the circuit breaker has been revised several times based on the feedback from the previous past crisis. Here's the current rule. There are three different levels. The threshold for level 1 is 7%. Once S&P 500 drops 7% from its previous closing before 3:25 p.m. Eastern Time, trading will be halted for 15 minutes. The threshold for level 2 is 13%. After the market drop below the first level, it would take a drop of 13% before 3:25 p.m. for the next circuit breaker to kick in. That would kick off another 15 minutes trading halt. The final threshold for a trading halt is pegged to a decline of 20%. Once the S&P 500 has fallen that much, that 20% on a single day, trading will be halted for the rest of that day. Well, we have to say that the market has never seen a 13% or 20% decline ever since the circuit breaker guideline went into effect since 2013. Moreover, whenever a halt occurs, all of the tradings associated with the derivative contract, such as the options or futures, will also be suspended. Now, let's take a look of the market on Black Monday of March 9, 2020. We can see from the intraday trading graph of S&P 500 that there is a very sharp decline right after the market is opened. Well, the reason behind this market plummet is convoluted. It's very complex. It's a combination of the fear of the recent coronavirus outbreak and the crash of the crude oil market due to the failure of agreement on OPEC Plus production cut between Saudi Arabia and Russia. Well, that's a long story, which probably we can talk in detail in another video. After the market drop to the threshold of 7%, it triggered the first level of circuit breaker. And we can see that the price line is flat for 15 minutes and with zero trading volumes in that period of time. Notice that once the 7% level is triggered, it will not be triggered again. So for example, in this day, the market is actually closing at 7.6% lower by the end of the day, but it will not be halted for the second or the third time, after the market drop below 7%. That 7% only works once in that one trading day. The next threshold will be 13%. A decline in SP 500 by that much would similarly result in a 15 minutes hold. To trigger level 2 circuit breaker on Monday, the index has to drop 386 points to 2,585 points. And in the chart, the second dotted line is the second level. It has to drop to that point before the market triggers the second level circuit breaker. And trading won't be interrupted if that drop came after 3:25 p.m. When the market is kind of closing or towards the closing period of time, then the market will not be halted. To hit level 3 on Monday, SP 500 will need to fall 594 points to 2,377 points. If that happened at any point of that trading day, it could before or after 3:25 p.m., the market-wide trading will be halted for the remainder of the day. It is interesting to note that on March 9th, 2020, also marks the 11th anniversary of the longest running stock bull market in history. Well, first of all, a bull market, how to define that? A bull market is defined as 20% increase on a closing basis that is never interrupted by a subsequent 20% decline. So stocks have been climbing higher and higher and making all-time high since the post-financial crisis, the lowest low on March 9, 2009. The bull market in stock has continued since then. In this figure, we can see that there are a few shaded areas. Those are the major market correction since March 9, 2009. The most recent one that almost killed this bull market is the 19.8% correction at the end of 2018, often referred to as the Christmas Eve massacre. Investor traders were hoping for a Santa Claus rally, as historical trend shows stock tend to climb up in the last few weeks of December because investor and consumer has a very good sentiment before the Christmas holiday. And in 2018, it turned out the Santa Claus rally turned into a Christmas Eve massacre on Monday, December 24th, the Christmas Eve of 2018. And ever since then, it is a V-shaped rebound and a spectacular year of 2019 until this very recent market sell-off that triggered the circuit breaker on the 11th birthday of this bull market. Now, let's trace back to the history and the root of the circuit breaker, where that come from and why we have it. The former U.S. Treasury Secretary Nicholas Brady is credited for bringing circuit breaker to stock market as a recommendation to the former President Ronald Reagan. Following the Black Monday crash of October 19, 1987, which sent SP down 20.5%. The crash begins in Hong Kong and soon affected the market worldwide and came to known as the Black Monday of 1987. Many people believe that the crash had been exaggerated by all of the flooding order on the exchanges, especially at the time the computer accurate trading is come into place. Therefore, SEC expect that a mechanism to temporarily time off the market will help clear this and calm this market, and that lead to the creation of the circuit breaker. About 3 months after this Black Monday, it was implemented in the market. Although the circuit breaker history dated back decades to 1988, when it was first implemented, before this Monday of March 9, 2020, there was only one other instance. That was on October 27, 1997, when the market-wide circuit breaker was triggered for the first time. At that time, the threshold of circuit breaker being triggered was still pegged to the point change in the Dow Jones index. It was initially based on the absolute point drop rather than a percentage drop. On that day, now often nicknamed as Bloody Monday, the market was halted twice. The first time, the Dow Jones index fell 350 points and the market was halted for half an hour. And then the Dow Jones fell 550 points. The market was halted for the rest of the trading day. That 550 points drop is translated to a 7.2% drop in percentage. Well, you can see that this 1997 episode very quickly spurred some debate among traders, exchange officials, and SEC about whether they should keep using absolute points drop or they should translate it to a percentage change. Especially when the market is rallying and moving higher and higher, this 350 points become less and less significant on the percentage basis. And that was changed in an updated rule put into effect in 1997. For example, now after that, if the Dow fell by 10%, the New York Stock Exchange can hold the market trading up to 1 hour. The size of the drop is also associated with the duration of the hold. The larger of the decline, the longer the trading hold. And there are other circuit breakers in place for declines of 20% and 30% of that single day. SEC has subsequently revised the circuit breaker multiple times. The most recent one is after the flash crash in 2010. That was on Thursday, May the 6th, 2010. On that day, it is United Kingdom's general election day. In the US, the Wall Street was concerned by the mounting anxiety about the Greek debt crisis. In the afternoon session, in a few minutes, Dow Jones plunged nearly 1,000 points, or about 9.2%. Hundreds of billions of dollars are wiped off from the market. Companies are affected, including household names like Procter & Gamble and GE. And mysteriously, the markets then quickly rebounded, recouped almost all of the losses in minutes. This very extremely roller coaster type of behavior was then coined name as flash crash. There are a lot of panics among traders crying for knowing what's happening and why we're seeing such very strange behavior. And there are also multiple explanations for that, which we'll leave for another day. As our focus is on the circuit breaker for this video, we'll leave the story behind the flash crash for another story. Now, some of you may be confused by why this very sharp 9.7% market drop didn't trigger the circuit breaker. As we say, this Monday was the second time after the 1997. So this 2010 flash crash actually didn't trigger on that circuit breaker. Why? And that is because the threshold at the time is for 10% decline in the Dow, which is not reached. Therefore, the very dramatic trading was allowed to continue. In the aftermath of this flash crash, SEC officials once again revised their guidelines for a circuit breaker, now adding SP 500 index and also the level 1 and level 2 of 7 and 13% into the system. There are also similar breakers in effect for Russell 2000 and also for many exchange traded fund ETF, global market as well. Here's a chart for the biggest SP 500 one-day drop. The Black Monday in 1987 is the sharpest one-day drop on the very left of the chart. And what happened this Monday marked the 19th most severe one-day drop in history. Well, I think that's enough for today. In the second part of the video, we will talk about the circuit breaker for single stocks for the futures market and also its practice in the other countries. I hope you enjoy it.